The content presented in this podcast is intended solely for general, informational, and educational purposes. Nothing herein constitutes or should be construed as financial, investment, legal, or tax advice. You should not act or rely on any information in this podcast without seeking the advice of a qualified financial professional. This audio/video podcast is an AI-generated product produced using Notebook LM. It automatically summarizes and synthesizes reports, analyses, and commentary originally published at reflectionsofreality.substack.com. All views, opinions, and analyses expressed are those of the original author and do not represent the views of any financial institution or regulator. Past performance is not indicative of future results. All investments involve risk, including possible loss of principal. CO Reflections of Reality. All original content rights reserved.
Welcome to today's Explainer. Today we're taking on a really fascinating, highly focused breakdown of the Convergence brief. Basically, we're going to synthesize the predictive probabilities of the crowd with the cold, hard, mechanical reality of the market tape. We're decoding the exact structural forces dictating our swing trading horizons right now, and it's a pretty wild setup.
Okay, let's dive into this. We've got a strict roadmap to follow today. 1. 2 lenses, 1 horizon. 2. Lens 1, poly market. 3. Lens 2, the weekly tape. 4. The convergence verdict. 5. The rotation map. And 6. Trading the swing books.
Starting with Section 1, 2 lenses, 1 horizon.
To actually navigate this current market without flying blind, we're bringing together 2 fiercely independent frameworks to give us one actionable swing trading horizon. Think of it like a giant puzzle. Lens 1 is poly market. That's our probability-based, forward-looking predictive engine. It's telling us exactly what the crowd is pricing in for future geopolitical and monetary regime shifts. Now, Lens 2 is the weekly report. This one is entirely measurement-based. It doesn't care about predictions. It focuses strictly on the mechanical reality of the current tape, the institutional flow and breadth happening right this second. It's essentially prediction versus reality.
Let's move to Section 2, Lens 1, Poly Market Probability Map.
So let's analyze that first independent variable and see what the crowd's money is actually anticipating. And wow, look at the stark realities being priced in here. The crowd is pricing in a durable, higher-for-longer Federal Reserve, and that's anchored by a whopping 77.0% probability of 0 rate cuts in 2026. That 77% is basically a gravitational center holding the U.S. 10-year yield and anchoring the DXY. But that's not all. We're also seeing only a 17.5% chance that the Strait of Hormuz normalizes by June 30th. That injects a massive geopolitical risk premium straight into energy and gold. This is the macro world the crowd sees coming.
All right, Section 3, Lens 2, the weekly tape.
Now we're going to step away from those forward-looking predictions and look at the present mechanical reality of the tape, relying strictly on the Barrel Protocol's proprietary indicators. First up is the MDI, or Market Dashboard Index. By strict definition, the MDI measures overall market sentiment. A reading of 10 to 35 places us in the bullish mean reversion zone, but the band we really care about is 50 to 65. That is the bullish kickoff zone.
And guess what? That is exactly where we sit today. The MDI's reading 51.0. That puts us squarely in that coveted bullish kickoff zone. Historically, this is the absolute best risk-adjusted zone, yielding an average one-week return of positive 0.71% with a 63% positive hit rate. But, and this is a big but, we have to be incredibly careful here. The institutional positioning flows haven't confirmed this breakout yet. The engine is revving, but we're not fully in gear.
You can kind of see that hesitation when we look at our next proprietary indicator, the MVI. The MVI, or Market Valuation Index, measures how attractive stocks are versus bonds after adjusting for the business cycle. Right now, large caps are slightly expensive. SPY is at negative 0.69 and QQQ is at negative 0.61. But look at the small caps. IWM is sitting way down at negative 1.23. Small caps are significantly lagging, and that serves as a really stark risk-off signal hiding beneath the surface.
So the crucial point is how these underlying signals are fracturing our highest conviction setup, the triple play. By definition, a triple play is the high conviction alignment of 3 legs simultaneously. 1, the bull percent indicator. 2, positioning, known as the frontier. And 3, sentiment, measured by the CPR, or call-put ratio. Right now, this triple play setup is deteriorating. We've got a split signal. Frontier and CPR are bullish, but the bull percent is slipped below 50, which tells us the probability of a bullish continuation is eroding.
And that erosion is explicitly confirmed by our health metric. Now, health defines market breadth based on a machine learning flow model. High equals broad trend confirmation, and low equals divergence risk. Currently, the MT_health reading is stuck at a really low 40.80%. We are looking at a severe breadth crisis, guys. The current advance is incredibly narrow, basically just propped up by gamma-pinned names rather than broad market participation.
Moving to Section 4, the Convergence Verdict.
This brings us to the climax of the whole framework. We're bringing our two independent lenses together into a single matrix. And this brilliantly illustrates exactly what the market is doing. Look at Fed policy. Polymarket prices in 77% odds of no rate cuts, while the tape shows the deflation macro regime is dominant. They completely agree. It's a massive hawkish anchor. Then look at equity breadth. Polymarket shows a fragmented AI landscape, and the tape shows MTH at a weak 40.80%. Again, they totally agree. But check out the energy premium. Polymarket is pricing in severe Hormuz disruption, but the tape shows energy ETFs actively fading. Here, the lenses violently disagree. The market tape is pricing in a peace deal, while the forward-looking crowd predicts major disruption.
Section 5. The rotation map.
This huge disagreement creates an incredibly complex battlefield, and we navigate it using the rotation map. To read this map, you have to know these 4 proprietary states precisely. Accumulation is institutional buying or inflow. Rotation in indicates improving momentum, entering a bullish phase. Rotation out signifies fading momentum and profit-taking. And finally, liquidation represents institutional selling or outflow.
Now, what's really interesting about this slide is the dynamic currently playing out. You can clearly see that rotation out is dominating the market at 14.5%. However, look at liquidation. It just plunged negative 5.50 points in a single session. While the crowd is still taking profits, that sharp drop in liquidation is a massive developing bottoming signature. The washout is happening right now, even if the real conviction buying hasn't quite arrived yet.
A perfect example of this friction is the NVIDIA convergence gap. Polymarket gives NVIDIA an 89.5% dominance probability. The crowd is deeply confident in its future. Yet, when you look at the mechanical reality of the tape, that specific segment is actually showing an active liquidation phase. The monolith is fracturing, and the tape is literally punishing the crowd's certainty.
Finally, Section 6. Trading the swing books. So what do we actually do with all this data? We navigate this highly contested environment using 3 active swing books. The KISS book is maintaining a full cash posture, just staying completely out of the crossfire. The Beacon 1 book is taking surgical shots on select individual names, and the Mags_G book is managing our mega cap strategy. Let's move to and see how this builds a spectrum of risk for our active holdings. The cleanest setups on the board right now are names like UNP and CAT. They're sitting squarely in the accumulation state, heavily supported by defensive flows. Then you have the contested middle, names like TSM, Goldman Sachs, and Eli Lilly, which are just straddling the seam of these colliding regimes. And on the far end, you have the most exposed names like Macy's, trapped deep in the liquidation state.
The data is completely unambiguous, folks. We have a hawkish macro wall on one side and a fragile, incredibly narrow tape on the other. 2 regimes are colliding in real time. So I'll leave you with this to consider. Exactly where does your portfolio sit on the convergence map? You might want to analyze your holdings before the next catalyst hits. Thank you so much for joining me for today's explainer, and as always, keep your eyes on the tape.